Welcome to CEO Money. I'm Michael Yorba. I've got Peter Lupoff, principal of Lupoff Friends and Family Interests, on the show with me today. Peter, welcome to the show.
Thanks for having me. Appreciate it.
I'm glad you're here. All right, with the successful launch and 8-year run at Tiburon, why shutter and transition to a family office?
Well, it's interesting. I spent a good 25 years in the asset management business. I worked with some legendary figures, Marty Whitman of Third Avenue Fund, Izzy Englander of Millennium, before launching my own business, Tiburon Capital Management. And that would seem to have been fairly successful, except at some point in life you realize that you stop having fun doing the things that you relish and cherish, which for me were making the investments directly. And over time, between regulation, between dealing with the world-weary Swiss investor who's upset I've missed my benchmark by a basis point or whoever it might be, I spent more time doing things that I didn't like, that were administrative and growing a business, and less things that I relish and treasure, like making direct investments in the securities that I value. So at the same time, I've been training many students that came on, became very successful players in the asset management field. And so always sort of enjoyed the teaching and training and mentoring aspects. So by choosing to wind down Tiburon and relaunch as a family office, I could do the two things that I really had come to value. And at this point in life, I decided I want to do the things I want to do. So by being a family office, we have what I call time arbitrage. So I'm not rooted in a daily liquid, monthly liquid, or quarterly liquid, annual liquid product. I have the luxury of investing over a long time and making better decisions, such that, for example, Warren Buffett will say that, I can be greedy when others are fearful and fearful when others are greedy, and not really worry about monthly performance or thinking about short timelines. And secondly, investing that way means I'm not trading and as LinkedIn monitors every day looking at markets, and I can spend more time teaching. So I'm teaching up at Yale School of Management. I teach an investment class there. I also teach an impact investing class. And I know Mario Gabelli, and he helped get me to Fordham. Fordham's now Gabelli School of Business, where I'm a fellow focused on finance, and there I'm teaching impact investing as well. So the reasons were really I get to make the world the way I want it to be and participate in markets the way I want to.
Got it. Let's talk about mainstream nature of, say, impact investing. I wanted to hear, because I've known a few people that pioneers in this form of investment, and I'd like to get your take on that.
Well, impact investing is, I think, possibly in asset management, the biggest trend shift that people are not as focused on as they should be. It's sort of bubbling just beneath the surface. There are a lot of headlines that lead people to pay attention, with corporates and pension endowments thinking more about E, S, and G, environment, sustainable, and governance issues. But what's really most important is that over the next 30 to 40 years, $30 to $40 trillion changes hands generationally. And that enormity of wealth, when it changes hands, historically, wealth managers lose the client 98% of the time because families do not talk intergenerationally about the things that matter to them. Two millennials who will inherit this wealth, 70% in the hands of women first, impact matters. Whether it's a Deloitte or I think it's a UBS survey, show that millennials care how money is spent, not just that they make a return. Women skew even more to that approach. And so asset management, the traditional big shop asset managers to be relevant to this next generation, really need to embrace it. Secondly, there's a lot of data that's beginning to suggest that you can do well by doing good, that you can make market returns along with achieving social or environmental impact. And that, sort of changes the schizophrenia that we in markets have had generationally and historically, that we make money how we do with the one hand, where good and bad is irrelevant so long as we navigate the gray, and give money back in a philanthropic way. There's a little bit of schizophrenia in that is ameliorated by making investments that make money and also create a social or environmental goal.
Do you find that those types of investments these days are harder to find when they come with a scalable revenue stream that investors can get behind? I mean, I've seen several of those investments that the revenue stream just, or the revenue model doesn't, I misspoke, sorry. The revenue model just isn't always there. And it's harder to find something that actually does give a good ROI and does good.
I think you hit one of the issues right on the head, that in the surveys that are done by those attentive to it, like GIN, Global Impact Investor Network, one of the issues that family offices and pensions endowments, high net worths that are focused on the space fret about is a scarcity of scalable deals. So where I come to this, if people come to impact investing they come, as I describe it, from the do good world or the do well world. And I come from the do well world, right? I'm a traditional asset manager that has seen light of day on this topic. And so for me, due diligence and returns matter. And to bucket people this way, there are many in the space that dislike this analogy, that you're either a finance first person or an impact first person. Being a finance first person, I want a market return as well as the prospect of a social or environmental return. So that means that the deals that I look at narrow down to a scale where I have the shot at financial return, then it's so the case. So I'm not wasting, I shouldn't say waste of time, I'm not spending my time where impact investing feels like thinly veiled philanthropy. I'm only looking at those situations, whether they're fund managers, VC fund managers, private equity managers, credit managers. I'm looking at direct social enterprises only in those instances where economic returns are at market or close to market level. But to your point, I think the hard part will being able to do that in a scalable way.
Right. I agree with you. Let's move on. Are you still involved in distressed investing?
Yeah, so my history in the early 90s, starting with Marty Whitman of Third Avenue Value Fund, a legendary deep value investor, and because he was agnostic across the capital structure, seeking what we called the fulcrum security, that part that would participate in real ownership or equity value. During that first big distress cycle of 1990, the witch hunt of Drexel, I joined him, and there was more bank debt and bonds coming out of institutions that were sellers for reasons other than credit. And we made a significant return in that time. It was an easier time because distress was a small netherworld asset class. In fact, it wasn't a separate asset class. It was loosely dubbed a special situation because people had never really thought of it before. Well, now 20 years later, it is a significant asset class, but I am at heart a deep value investor as well as an impact investor. And so in my coding, with the magnitude of credit instruments, bank loans and bonds that have been put into the market over the last decade or so, as we saw the greatest unloved market return that has been experienced. we are waiting for the shoes to drop, and there are fissures in the markets that suggest that there will be another credit cycle. There just always are, and when that happens, debt will be the fulcrum security that gives you equity value. And in my experiences, since I have that experience, I choose to participate there. Now, as a family office, some of the things that I'm doing now, I didn't really intend it, but because of my background, I do active advisory work and expert testimony work for many hedge funds and active distressed managers that I know from the 20 years I have in the business. And that is an awesome cottage industry. Because while there is a new crop of talent at distressed shops putting money to work, about to put money to work, old dogs like me that have seen many things, or as Ray Dalio says, well, when he sees something, it's another one of those, fill in the blanks. I have 20 years of seeing another one of those, so I can help guide small startup managers. I can help shape the wizened managers, and I can help them all with their complex valuation or lawsuit or settlement issues where expertise around these topics are required. So I'm being drawn back into it now, in fact, advising a number of people.
Talk to me about the coming distress cycle that you see. You opened it up about your experience in this industry. What do you see going forward?
What would be really interesting is that the active distressed hedge fund managers are the best money raisers in the alternatives space. They're just, I think it's a great sell to go into institutional clients or to consultants and talk about the magnitude of debt instruments out there, the inevitability of market cycles, the dislocation that occurs in trading par debt when par debt trades at great discount, and the opportunity to take advantage of, as I mentioned earlier, sellers for reasons other than credit, so long as you have a longer time horizon, and then get those recoveries when markets rebound, and you can reorganize those companies and put them back out in public markets. The issue is that the scale of the money, while it may match the scale of indebtedness that could go bad over the next year or two, I really think it's probably a year or two, is that there are a couple of other issues about this time and place that are different than other cycles. One is it appears that we're no longer sort of in this sort of robust boom-bust economic cycle where you're seeing more gentle decline and gentle rise, and that they last longer. So, for example, this most unloved market recovery that we watched for the last decade, people think that's very long in the tooth, but there's also relatively shallow, steady growth. And that suggests to me that declines could also be not nearly as bad, one, longer than typical, two. And so what would be interesting, therefore, three, is that the returns from this distress cycle may not be what people expect. And I think there'll be a great distinction between the skilled manager and the less skilled manager, and it may be a debt or bond or bank loan picker's market, whereas in the past it has been sort of like just taking advantage of a market cycle.
I get it, and I can see where your expertise can really keep you head and shoulders above the rest of the people in the industry. Peter, thank you so much for being a guest on today's show. Really enjoyed the conversation.
Well, thank you. I enjoyed it as well.
You've been watching CEO Money with Michael Yorba. Thanks for watching. Like us on Facebook, follow us on Twitter, and subscribe to our YouTube channel.